Hey everyone, this is Kirk here again at OptionAlpha.com, and tonight I want to go over in depth a look at our recent vertical debit spread that we traded in Oracle. So what we do here each and every night on the membership side of our blog, and if you're viewing this video, you're obviously either a member, or if you're viewing this on YouTube, you're getting this video about 7 to 10 days after it's sent out to just our members. But we go over all of our opening trades and all of our closing trades. Now today we only had one new order, and that was this order in Oracle for a debit put spread. And since we usually have a lot more than one orders in any given day, I wanted to take extra time tonight, since we have time in the video, to go over the details of how we found this trade, how we selected the strikes, and how we determined which strategy to trade. So it'll kind of be a mini video tutorial here on how to choose and trade vertical debit put spreads in the market. So the nuts and bolts of the trade are this. We traded a vertical spread for May, which is not this first expiration month, but actually the next expiration month out. And we bought the 42 strike puts, and then we went in and sold the 41 strike puts. And the difference between the buying of the 42s and the selling of the 41s was a debit of 49 cents. So at the end of the day, we actually paid about mid-price of the spread, which is ideally what we want to do, right? The width of the strikes in this case is $1. And for debit spreads, we want to pay about the width of the strikes, or about half of the width of the strikes, in this case 50 cents. So we paid just about a penny shy of that, and actually just about exactly mid-price. The penny is really, really close. So that is our actual trade. So it's a 50-50 probability trade, and we'll go over that a little bit more. It is not one of our high probability trades where it's a credit spread or an iron condor or a strangle or a straddle, but it is a trade that you can make in low volatility environments. So let's actually first go over to our strategy guide right here on OptionAlpha.com. Now, if you're a member, obviously you get access to this strategy guide. It's something that is so simple, but so powerful. It's something that I've wanted to develop for a long time, and a couple months ago I actually started putting the action into place. And again, it's so simple, but the simplicity of it can't be underestimated as to how powerful it is for choosing the right strategy. So as always, what you do on the strategy, guys, is you do all three steps right in order. So the first thing we want to do is make a directional assumption on a stock. And again, it doesn't matter what your directional assumption is. Are you bullish, bearish, neutral, whatever the case is, no bearing on what strategy you choose at the end of the day. Just pick something. Are you bullish, bearish, or neutral? So in Oracle, we'll show you guys the chart here in a little bit, but we were actually bearish in Oracle just because of the chart setup. Again, it really doesn't matter. Now, the next thing you want to do is you want to choose where implied volatility is, or find out where implied volatility is. Is it above or below the 50th percentile? So we did a very long tutorial on that last night where we talked about implied volatility in Tesla and some other stocks as well. And this is really the key ingredient to this whole business of choosing which option strategy to trade. You got to find out where implied volatility is. Is it above the 50th percentile or below? If it's above the 50th percentile, meaning the implied volatility is higher than it generally is, then you want to focus on option strategies that take advantage of selling options. And we've already laid that out below, and I'll show you guys that. Now, if it's below the 50th percentile, you want to take advantage of option strategies that are net buyers of options. And again, we lay that out below. It's very easy to understand. Now, once you know exactly where implied volatility is, the final step is actually just choosing your strategy. So we've laid out some of the top strategies that we use. There's obviously a ton of strategies, but we focus on the ones that we actually use and implement right here at OptionAlpha.com and have for years. And so those are the strategies that we've laid out below. So the first step is directional assumption. The next is implied volatility. And the third is to choose your strategy. So if we scroll down, you see how easy we've made it here. We already just show you, okay, this is the column where you choose direction. So in this case, if you're bullish and the IV rank is high, then you choose one of these three strategies. If you're bullish and the IV rank is low, then you choose one of these three strategies. And you can quickly click through all of those strategies and see how they set up and what their risk reward is, time erosion, break-even price, etc. So we're going to scroll all the way down past bullish and past neutral directional assumption, and we're going to go here to bearish. So we're bearish on the market. Now, because implied volatility is not high in Oracle right now, we actually are not going to use any of these strategies here on the left. So we're not going to use a credit spread, we're not going to use a short call, and we're not going to use a butterfly. We're just not taking advantage of the right positioning for implied volatility for an options trade. So instead, what we're going to do is we're going to focus on these three here, which are our calendar, our debit spread, and our back spread. Now, in this case, we could have traded the calendar for sure. We could have absolutely traded the calendar. We could have traded the back spread, or whatever the case is. But in this case, we actually chose to go with the debit put spread. So right below, it actually shows you exactly how we set up this trade. So we're going to buy one put, and then we're going to sell one put at a lower strike. Right, but at the end of the day, that doesn't really help you, and it's really hard for me to put in here exact parameters for every single possible outcome. So instead of doing that, we actually go over this and we use these video tutorials that you're watching now as a guideline for how to make those trades and select the strikes. So if you already know that we're going to buy a debit put spread because we're bearish on Oracle and because implied volatility is low, then what we do is we just head on over to the charts of Oracle so you guys can see exactly what we're talking about here. All right, so now that we're at the charts of Oracle, you can obviously see why we're bearish on Oracle. We've had a number of days that have been just high, just moving continuously higher, and it's almost gone parabolic here, kind of after earnings. Now, that doesn't mean it can't continue, obviously, but historically, you look back and you see some of these same type of parabolic moves in Oracle, and you see that the stock actually either stopped or declined after moving that far. So this is actually much further than it usually moves, and you'll notice that today we had almost a big shooting star candle pattern up here where the actual high of the day was much higher than the stock actually closed. It still closed up high and above the open, but it actually retreated from the highs at the end of the day. Now that's the only reason that we're directionally bearish, right? So again, if you're bullish, it doesn't change anything. It just changes the strategy that you trade or the direction of the strategy. Now the reason that implied volatility is low is because we look up in the top left-hand corner and you can see that the IV rank is at 41. So this doesn't mean that Oracle has 41% implied volatility. What this means is that generally 60% of the time over the last year, implied volatility has been higher than it is right now. So that tells us that we are not going to be net sellers of options. Instead, we're going to be net buyers of options. And that's why we're trading the debit vertical spread in Oracle. So if I actually go to the trade tab, we can break out this trade here so I can show you guys exactly where we're trading this. And again, the idea with these debit vertical spreads is that we want to make it a 50-50 probability bet. So we're not trying to make a high probability bet. This is just a position that we want to use to make a directional assumption in the market and be fairly conservative in risk management and how much capital we're allocating. Now you'll notice down here in the bottom, as always, we have all of our positions, so you can clearly see this is a live position that goes out. All of these positions that we talk about are live actual fills that get executed. We're trading the May contracts, which have about 45 days to go in expiration, so that's about where we want to target some things for these debit spreads. April is a little bit too close in right now at 17 days, just doesn't give us enough time, and May gives us plenty of time to make a directional trade in Oracle and for this thing to go the right way. Now you'll notice on the bottom right-hand corner of the screen where our positions are. So you'll see that our first strike where we bought is indicated by the green tab, and that is the 42 strike puts. So we bought those, and then we sold the 41 strike puts to help finance a part of the purchase of the 42 puts. So at the end of the day, you'll look down here in the bottom, and you'll see the actual prices that we paid versus different than where the market ended up at the day. We actually paid $1.48 for the 42 puts, so we bought those for $1.48, and then we took in a credit of $99 for the 41 puts. So the difference between those is our $49 debit that we paid. Now you'll notice that this is definitely a probability or 50-50 probability trade because you'll see that the mid price around these right now is $41.50. So that is the break-even price that we have, which is almost exactly where the market traded at the end of the day and where it closed. So if we know that the markets are 100% efficient and that stocks truly have a 50-50 chance of going either up or down, then this trade puts our break-even point right in the middle. And so what we like to do with these debit spreads is we like to straddle the market. Don't confuse this with a straddle, but we like to straddle the price of the actual underlying security. So in this case, the price was $41.50. So we traded an option on either side so that our break-even price is as close to that market price as physically possible. It doesn't always get down to the penny, and in fact, in this case, it's exactly the same price as it is right now. It doesn't always happen like that, but that's ideally what you're shooting for. You're shooting for a break-even price, which is matching Oracle's current price, and that gets you a true 50-50 probability bet. So last thing I want to take a look at here is the actual Analyze tab. I know everyone loves the Analyze tab. So you'll see that this Analyze tab actually matches up exactly the same as our debit spread profit loss diagram that we have on the website. So you can see this is exactly what it is. And here's our profit loss diagram. This is exactly what it looks like at expiration. If we go back to the Analyze tab on Thinkorswim, you'll notice that the profit loss line here in red matches up exactly to that same profit loss line that we had on our Option Alpha platform. So this is truly why this tool was developed, this ultimate strategy guide that quickly enables you guys to choose the right strategies and put them into use. Even if you don't have access to the Analyze tab here on Thinkorswim, or your broker doesn't have it, whatever the case is, this allows you to quickly choose the right strategy for the right situation in every market setup so that you're never left deciding which strategy to trade. But you'll notice here on the Oracle trade that the current price of Oracle is designated by this dotted line, which is right down the middle of the screen. So this is where Oracle closed at the end of the day, and that's 41.49. Now you see that crosses with the zero barrier almost exactly right where our stock price is and our trade price. So you can see that this is truly a 50-50 bet. If Oracle trades lower than this, then we're obviously going to make some good money. If it trades higher than this, then we'll lose almost exactly the same as we could possibly make. Remember, this is a 50-50 probability bet, but it is a directional trade on the market. So all we're betting is that at some point in the future, we're going to have an opportunity to take profits on this. And again, just looking at the stock chart, I think that's a pretty good analysis that we could possibly take some profits on this in the next couple of days as people start to unwind this position. They clearly started to unwind it at 42 today, which is the high. And so all we would need to see is a move down to 41 or even 40.50, and we'd see a nice return on our investment for this position. So I hope this was a really helpful video to go over the trade that we made here in Oracle today. Again, I know we don't get an opportunity to go over each and every trade as in-depth and as detailed as this, but we do have a lot of video tutorials on our website, especially for members in the members section that go over different strategies in detail. But again, hopefully this was a great video tutorial for how to trade debit vertical put spreads in the market. So if you like this video, please share it on social networks, add a comment right below to this video. I'll get back to all of those comments tonight or tomorrow before the market open, and happy trading.